Уважаемые участники форума, рад вас приветствовать и открыть аналитическую сессию форума, в рамках которой будут представлены обзоры и ключевые тренды развития российского и международного рынка золота. Представляю вам участников сессии. Джон Рид, управляющий директор, главный рыночный стратег, Всемирный совет по золоту. Харис Чопра, старший консультант, Институт управления Ахмадабада, Индия. Антон Чернышов, младший стратег по операциям на товарных сырьевых рынках с версией. И Анна Морина, начальник аналитического управления Открытие Research, Банк Открытие. Представительный состав спикеров позволит нам ознакомиться с ведущими тенденциями и вызовами международного и российского рынка драгоценных металлов. В связи с этим предлагаю начать нашу сессию с доклада Джона Рида, посвященному новациям развития международного рынка золота. Пожалуйста, Джон.
Hello, my name is John Reed. I'm the Chief Market Strategist at the World Gold Council. It's an honor to be talking to you today regarding the gold market. The World Gold Council is a market development organization for the gold mining industry from around the world. We've been in existence for about 33 years now, and we represent about 30 mining companies from most of the major markets. And our role is to explain the gold market to investors and to help make it easier for investors and for other buyers of gold to access the market. We do a number of things that are shown on this slide, providing data, analytics, research, and market knowledge, all things that I'm responsible for as Chief Market Strategist. We also attempt to make it easier in some markets for people to access the gold market, either through changing policies or working on market infrastructure. So I'm going to start off by talking about the strategic case for gold. This is the argument that we make to investors around the world about why gold should be in your portfolio all the time. The argument is very simple, and it starts off by looking at what returns would investing in gold have given you over the long term. Some people think that gold is only in a portfolio useful during times of high inflation or crises, and that's simply not true. If you look how gold performed during or since 1971, when we came off the gold standard, you'll see that its average returns have been in line with other asset classes. And that's true over the last 20 years as well. Only over the last 10 years has gold's performance been somewhat less than particularly the very strong performance from US equity markets. But it's been a source of returns over these three periods. It's also been a very effective portfolio diversifier as well, because gold is not correlated to equity markets. In general, there's no correlation. But if you look under certain circumstances, you'll see that, for example, when the US equity market, the S&P 500, is increasing by more than 2 standard deviations in a week, you get a modest positive correlation. But look what happens when the S&P 500 falls by more than 2 standard deviations in a week. That correlation turns negative. And that flip over in correlations is really useful. You want to be positively correlated to things when they're going up strongly, and you want to be negatively correlated to them when they're falling. And gold's the only asset class we found that does this. I've shown on this chart as well the performance of commodities in red, and you'll see that commodity correlations increase during sell-offs, and that's really not helpful. Gold is a liquid market as well. About 180 billion US dollars of gold trade a day, about 2/3 of that in the over-the-counter market, about 30% of it on exchanges around the world in the United States, in China, Russia, etc. And then a small proportion in exchange-traded fund markets. That's comparable or better than many other asset classes, as you can see from this chart here. Gold is not as volatile as you think either. If you read news stories, you always hear how gold is a risky or a volatile asset class, but that's simply not true. Its volatility is in line with major emerging market and US equity markets, and better than any of the other commodities that you can see on this chart here. And fairly uniquely, gold helps protect portfolios during crises. I've outlined a number of crises that have taken place over the last 30 years here, and you'll see that the performance of gold has generally been good, if not the best, out of all of these potential hedges within your portfolio. And whilst it's true that owning the VIX, or the volatility index, over this period would have delivered better returns, the cost of holding the VIX normally is really high, whereas gold actually pays you historically for owning it through contribution of returns. So we think gold is the most effective risk management tool that investors can have in their portfolio. So putting all of these factors together, returns, diversification, liquidity, volatility, and protection in the portfolio, we find that adding gold to a portfolio increases the risk-adjusted return of that portfolio under almost every circumstances. This chart here shows a US pension fund over the last 10 years. And you can see the average risk-adjusted return on the left-hand side. And then we've added gold to that portfolio, proportionally reducing everything else. What you can see from this portfolio is about 5% weighting in gold seems to be the optimal allocation to increase the risk-adjusted return of that portfolio. And it's not just US portfolios that benefit. Every other portfolio that we've studied, and we've conducted this exercise in lots of different markets, shows the same benefit. Having somewhere between about 4% and maybe 8%, depending on the individual market, has increased the risk-adjusted return of a portfolio over the last 10 years. And if you remember one of my earlier slides, gold's performance over the last 10 years has actually been the weakest of those three periods that I showed. If you run this exercise even longer, so over the last 20 years or since 1971, you get even higher target weightings for gold. So let's move to the gold market at the moment. What's been going on? Well, this chart here, which is taken from our website, Gold Hub, shows the drivers of gold this year. Now, we break those down into the main factors that drive elements of gold demand and therefore price performance. And what you can see, I know it's a complicated chart and I apologize for that, but what you can see if you look at it, it's that there's two factors that really worked in the first half of the year, and that was risk and uncertainty, together with opportunity cost, which we break out into foreign currencies and interest rates. In the second half of the year so far, it's been very much about opportunity cost, particularly coming through from interest rates. And in fact, it's the interest rate outlook and the expectations of monetary policy tightening from major central banks that's driving gold a lot at the moment. I often get questions, why has gold performed so poorly this year? Because indeed it's basically flat in an environment when many other assets have performed really strongly. And the reason for that, we believe, is because we're in the midst of a reflation trade. 2020 saw economies hit by the coronavirus pandemic very hard. Assets fell in value and gold performed very well, delivering about a 25% return in US dollars. Since August, or since the end of August last year, this has reversed. As people have been expecting the global economy to recover from the coronavirus pandemic, we've seen growth assets like commodities, like equities, doing much better. And some of the things that did very well last year, particularly gold, has seen some profit taking. And this is entirely consistent with what we've seen in the past. Historically, In a reflation, in the first phases of a reflation trade, gold tends to underperform. Other commodities, equity markets tend to do much better, but gold's performance catches up on a 1 year, 2 year, 3 year view. So we're not surprised by the relatively weak performance of gold this year, and nor are we worried by it, because historically gold has caught up thereafter. Now I'll turn to the supply and demand environment for gold. And it's worth explaining up front the balance of demand for gold. About 41% of gold demand goes into consumer applications of jewelry and technology. About 42% goes into investment, and 17% is from purchases of central banks. Now, these are averages over the last 10 years to strip out the volatility you'll see on a year-by-year basis. And that's important because particularly when you look at 2020, it was quite a remarkable year. We saw a collapse in consumer demand last year because of the impacts of the coronavirus pandemic and the closures of markets. And yet we saw a surge in investment demand, particularly from exchange-traded funds. This year is seeing a return more towards normal. So we're seeing a big bounce in consumer demand, both from jewelry and technology. Bar and coin investments, so buying of small investment bars and coins, remain strong. But we've seen a big change in the ETF landscape. Exchange-traded funds were a major contributor to the strength in gold in 2020. But we've actually seen small outflows this year as well. So that's a big difference. Central banks continue to buy gold, and it's probably the area that we've been surprised by the most this year is just how strong central bank buying has been. And then finally, touching on supply, overall gold supply isn't really increasing this year. Mine production is increasing a lot, but the recycling of old jewelry scrap is down a lot on last year. And that's limiting the impact of this increase in mine production coming through. I mentioned central banks, and you can see how strong central bank purchases have been this year. Last year, central banks didn't buy very much gold, and indeed there were some sellers, and that's an entirely normal reaction during financial crises. This year, however, we've seen central banks come back and buy in good quantities, and we've seen purchases from central banks that we weren't perhaps expecting to buy gold as well. Based on our contacts with central banks around the world, we expect this trend to continue. Net central bank purchases, and with occasional surprises coming through from central banks that we weren't necessarily expecting. I mentioned mine supply, and it's an interesting story. We certainly have seen a sustained increase in mine production over the last 10 years. And although there are signs perhaps that that might be flattening out, so far it looks likely that 2021 will see a record level of mine production. Now, there are shortages of new projects and expansions for the mining industry, but that's not being reflected so far in the performance in 2021. So if we are going to see a peak in mine production, it probably won't be this year. I mentioned recycling, and recycling is an important part of the market. Old jewelry that comes back to the market, and it can be in excess of 1,200 tons per annum, even more than that sometimes during financial crises. Now, last year, with the gold price high, we did see an increase in the recycling of old jewelry. This year, however, that's fallen sharply. Part of it's because the gold price is a bit lower, but part of it, I think, is because the stock of jewelry available for people to sell back to the market may be depleted. It's not very long since we saw the previous all-time high price in gold back in 2011, and a lot of recycled jewelry took place back then. Finally, I think it's worth noting that there's been less distress selling of gold jewelry than we would have expected normally in a crisis, And that's because of the policies that have taken place by governments to try and protect their citizens during the coronavirus pandemic. So in conclusion, the gold market is normalizing in 2021, and this should continue in 2022. I would expect to see a further recovery in jewelry demand, and technology demand should stay strong. Central banks, we believe, will continue to buy gold on a net basis. And whilst ETF investors have been missing in 2021, I suspect we will see an improvement going forward, particularly if inflation and stagflation pose a problem to the global economy. And that's where the upside risk in gold comes from. The downside risk, however, comes from central banks' policy. If central banks are able to tighten interest rates and tighten monetary policy without damaging the global economic performance, then that might pose a downside risk for gold. In terms of the supply side, we don't see any major threats either to the upside or downside in mine supply next year. We will see, however, the recycling of old consumption continue to offset the stronger mine production that we've seen in 2021. So I'd like to thank you very much for your time, and I look forward to catching you up with you in person in Moscow, hopefully next year. Thank you very much.
Спасибо большое за интересный доклад, Джон. Продолжение обзора инноваций.
Thank you so much for a very exciting presentation. With this, I would like to pass the floor to Harisha Chopra on key trends, challenges, and recent reforms in the Indian market of precious metals. So the floor is yours.
And thank you, John, for providing a useful insight on the gold prospects. And some of these trends are already seen when we look at the Indian gold market as well. A big thank to the forum for providing me this platform to speak and provide my thoughts on the Indian gold market. Let me give a small introduction of myself. I represent India Gold Policy Center, IGPC as it is popularly known. It belongs to the most premium management institutes in India, IIM Ahmedabad. And we basically at IGPC work very closely with the market participants and the decision makers on the gold policy initiatives and its implementation. I have been associated with the bullion industry for over 20 years, and I had been working with the Bank of Nova Scotia for almost 16 years. So coming back to the trends, the key trends of this year, basically we had seen a dismal first 2 quarters, but the year 2021 turned around towards the end of the year, and the upcoming year looks very promising. Last week, I attended the XIV International Gold Conference at Jaipur, and it was held in a physical format. The attendance and the enthusiasm of the participants was just overwhelming. Everyone seems to be bullish about the future prospects of bullion industry, and India is no exception. It seems the COVID fear is fading away at last, and that's a good sign. Coming back to the day's agenda, today I'll be talking about the recent key trends and the challenges in the Indian bullion market, and also about the reforms that India has undertaken in the past couple of years. While most of you are aware of the first 2 segments through various publications and reports, I'll put a little more focus on the reforms part, which is more relevant the world is looking forward to. So let me start with the major factors that drives the Indian gold market. So can I have the slide 1, please? Okay. Okay. So basically there's some problem in the slide. I can see. Yeah. Can we push to the next slide, please? The first slide. Yeah. Okay. So the major factors, let me discuss about the major factors that drives Indian gold market. India is a large consumer market, only second to China. But unlike China, almost all of its demand is met through the imports. The data points which are used here are basically taken from the various reports published by the World Gold Council and Metal Focus. India's primary driver for gold demand is its traditional culture. The demand for jewelry goes up during the festival and wedding times. Income levels, government policies, and gold price trends play a major role from the long-term perspective. While in the short run, the factors like inflation, taxation, and the monsoon are the major influencers. It will be safe to say that jewelry demand is largely driven by the long-term factors, whereas short-term factors give direction to the investment demand. It is estimated that for every 1% increase in the per capita income, the gold demand rises by about 0.9%. On the other hand, 1% increase in the rainfall results in 0.2% increase in demand. Indian rural demand is largely driven by the cultural, religious, and de facto investment needs. The urban belt is more informed and is mindful of the transaction cost, and that is why they prefer instruments like bars, coins, and digital gold products. It is to be noted that rising urbanization in India will lead to change in the consumption pattern. Can we move to the next slide, please? So gold demand, which was affected by COVID, has picked up, as I said in the introduction. As discussed in the previous session, India's gold demand also witnessed a strong rebound, which is in line with the global demand. The goods and services tax is a good indicator of how the economy is doing. It is heartening to note that GST in Q3 is back to the pre-COVID levels, indicating a strong recovery in the economy. GST has in fact surpassed the Q1 levels also, which was a pre-lockdown period, by about 5%. In fact, gold imports in August and September were about 120 tons and 100 tons respectively. The vaccination program has been successful after a bumpy start. And so India, some of the data points I want to bring in here. India's working age population is likely to add on an average about 7 million workforce each year in the next 2 decades. And India remains the largest populated countries and also the youngest one. The median age at present is 27 years and is likely to be within 35 in the next decade. Next slide, please. India is definitely progressing towards a strong era of economic expansion, which will lead to rising income levels, more disposable incomes, and a growing middle class, which are all conducive to a good gold demand. Employment in agriculture has declined from 63% in 1991 to about 43% in 2019, and is also projected to decline to about 25% by 2050. Share of agriculture income in the GDP of India is down from 41% in 1960 to now 16%. Urbanization, as I mentioned, is now up from 18% to 34% within the same period. Such a shift in the income pattern are indicators of both the growing urbanization and the rising income levels. India's savings has increased from 6% in 1960 to over 34% in 2010, before tapering off a bit since then. Next slide, please. So let me talk about the challenges that the Indian bullion industry faces. We have a very high import duty, which leads to a growth in the unofficial market. A large size of the market is still unorganized. There has been a lot of efforts by some of the large corporates to make this more organized. But still, we are still far away from 100% organized market. Institutional participation is limited. Banks are playing a very limited role in the whole ecosystem. Then India has not been successful in gold monetization, though we are sitting on an estimated 25,000 of gold with its households. Most Indians prefer to hold physical gold. There is a lack of efficient price discovery mechanism and standardization of quality. Next slide, please. So the decision makers in India are well aware of these challenges and have taken various initiatives to address the same. we see the regulators becoming much more responsive to the reform needs in the past couple of years. And in fact, in what India has done in the past couple of years is that Indian gold delivery norms have been released in January 2020 by the Bureau of India Standards. Then Indian commodity exchanges introduced gold options in early 2020 to facilitate hedging. There was always a demand of having a unified regulator for the bullion industry, and that has been met. The International Financial Services Center Authority was created to develop and regulate the financial markets in India in the free zone in financial services, which is known as the IFSC, Gift City in Gujarat. To also, there were efforts on bringing trust in the purity of gold. Hallmarking has now been made mandatory, and there are initial hiccups on the infrastructure front, but that are also being taken care of as we speak. There has been a greater engagement between the Indian participants and OECD to devise a workable implementation plan for responsible sourcing of gold. I switch to the next slide, please. Continuing the reforms in recent reforms. So India has rationalized the import duty on gold. So for the first time in the past few years, the import duty was actually reduced by about 2% in the last budget. There has been expectations to reduce it further going forward. The regulators' engagement with the participants on the gold monetizations scheme has been more regular now, and they also came out with the revisions. There also has been some steps taken to address the roadblock in the mining sector, and that will be a good news. Then also came the biggest announcement of the year. The announcement was in setting up of international and domestic spot exchanges, and that work is going on. I will be discussing that in the next slide. Next slide, please. So the development of gold spot exchanges to resolve the issues like institutional participation and unorganized trade and lack of products and transparency in the gold sector and recycling and standardization, they will all be taken care of once the spot exchanges start working. It is expected that these exchanges will start functioning from early next year. There are indirect reforms like digitalization of economy, rollout of welfare schemes for rural population, which will lead to financial inclusion and better income distribution. Indian reform process has been very consultative, which causes delays at times, but also ensures that there is least disruption when these initiatives are finally implemented. Though there are more efforts required towards the implementation. Next slide, please. So I just want to give you a little introduction of the International Bullion Exchange, in the short form IIBX, at the free trade zone. This is likely to be the gateway of gold imports going forward. These exact mechanism will be announced in the days to come. So this is as I said, this is a free trade zone, so there are no import taxes till the metal is transferred to the domestic area. So the IIBX has already incorporated in March 2021. There has also been a pilot run which was successfully concluded in August 2021. It is promoted jointly by the 3 leading Indian exchanges and 2 depositories. This is expected to be one of the major trading hubs of Asia with state-of-the-art digital platform and vaulting infrastructure. Next slide, please. So basically, who all can trade? The international banking units at which has branches at IFSC Gift City. Then the subsidiary and branches of entities dealing in financial products, which are also set up in the IFSC Gift Cities. Then there are certain banks and the nominated agencies who have been authorized by the regulators to import gold into India. So these agencies are also, even without their physical presence, they can operate from the Gift City. And then there are international banks and other traders can trade through the trading members if they prefer to not to have a physical presence. The trading modes are as it is order matching, block deals, market making, and benchmark price fixing. So what are the benefits of trading at IIBX? So there will be a improved price discovery, economies of scales because the imports will be happening at a with a larger volume and in the larger denomination. So economies of scales will also result in better pricing of the metal. It will also be an enabler to launch gold-backed financial products. As I said, the metal, as long as it is lying in the international area, is exempt from any taxes, local taxes. So there are like the banks will be jumping to these opportunities to develop financial products around that. There will also be an opportunity to dissociate metal procurement and leasing, deriving benefits of both these things. Then there will be a wider supplier base who would be interested to do business with India. And it will also position India as a leading global trading hub. And financing of the metal will also be more effective and more competitive now as compared to the earlier years. And as I said, that all this will also be tax efficient. And so this is something which India is really looking forward to. There has been lots of discussion around this during the last forum which I attended, and the regulators are also present there, which shows the seriousness, on their part to make this a successful venture. We all are looking forward to this initiative. With this, I will conclude my session. Thank you for your time and patience. Any questions? Most welcome.
Благодарю за обстоятельный доклад Хариша Чопру. Сейчас прошу Антона Чернышова детально рассмотреть динамику развития рынка золота. Пожалуйста, Антон.
Добрый день, коллеги. Рад вас всех приветствовать. В ближайшие 10 минут я расскажу вам о ценовых перспективах золота и почему мы считаем, что котировки будут уменьшаться. Я Чернышов Антон, младший стратег в команде Сбербанка КИП. Давайте же перейдем к слайдам. Следующий слайд, пожалуйста. Давайте перейдем к слайдам. Остановимся на основных тезисах. Во-первых, что вообще управляет котировками золота? Мы знаем, что золото – это такой очень надежный защитный актив. Соответственно, и конкуренцию ему составляют такие же надежные защитные активы. Это в первую очередь казначейские бумаги США и депозиты в банках. Оба этих актива, в отличие от золота, приносят фиксированный процентный доход, который становится очень важным в период, когда регулятор начинает управлять в экономике, когда он начинает бороться с кризисом, соответственно, золото кризис начинает расти, потому что снижаются ставки по банковским счетам, по казначейским облигациям. И в период, когда экономика восстанавливается после кризиса, золото начинает падать, потому что увеличиваются ставки, и золото становится не столько интересным. Сейчас мы находимся как раз в такой ситуации, когда после пиковых значений 2020 года золото начинает восстанавливаться, золото начинает падать, потому что экономика восстанавливается, и ФРС уже начала ужесточать монетарную политику.
is recovering, and rates of Federal Reserve System will be going up. And we expect additional correction of gold prices because Federal Reserve System will be tightening their monetary policy because of unfavorable conditions and inflation. However, we still think that small but improbable prospects for consolidation still persist for gold to grow, and we will discuss them in the end of the presentation. Let's move to the next slide. Let's focus on the key issue here of interest. So, gold prices were growing during economic instability. Whenever you have turbulence, uncertainty, you can see that here on this graph, you can from 2005 to when a global crisis took place, you see the regulator lowered the rates to help the economy, to support demand. So gold was good hedging assets, its prices went up when the regulator started tapering and tightening their policies, then the gold became cheaper. And we see this situation starting from 2018 when prices went up, and especially a sharp spike in 2020 during the pandemic when uncertainty was high. And now in 2021, when the economy is recovering, that we see that the gold prices are declining. Let's look at the next slide. We can discuss in detail mechanics and reasons, cause and effect, American U.S. Treasuries, and uh, gold prices. You can see on the left graph that U.S. Treasuries depend a lot on policies of the FRS. When rates are uh, lowered by the central bank, treasuries also fall. If they raise rates, then treasuries also go up. It's very simple. But if we try to understand why it matters for gold, let's look at the right graph, correlation, earnings on treasuries, and then what gold can do. We see an reverse correlation here. So we can see that from 2008 at the end of that year until 2012, yield was down and gold was growing in its value. So this is very standard, very much to be expected. So when monetary policies get tighter, yield is growing and gold starts to compete and loses in that competition because it does not bring the same kind of yield. So current situation, here's what we observe today. We observe key points here: high inflation rates, consumer and industry price indices. They're supported by high prices for commodities, and we see that inflationary expectations are also high, but inflation is of two types: good inflation and so-called nefarious inflation. So in the first case, inflation is part of the economic process of recovery, of economic development, basically, when it does not serve a blow to economy, but it basically supports economic performance. When it's fully under control of the central bank, it can lower it or even stop it altogether by working through financial tools. Nefarious inflation is different. We saw that in the 70s in the United States. In the end of the presentation, there will be a slide on this with more details. Back in those days, inflation was so strong and so prolonged in time that the central bank was not able to overcome it. So against that background, gold becomes a very attractive asset because nothing can compete with it, because gold prices were growing to such an extent that they really ensure that your savings are preserved. Now we see the central bank in the United States has a lot of opportunities for tightening their policies to handle inflationary risks, and currently to call inflation nefarious is too premature. But if inflation keeps going up, risks are getting higher that the regulator will tighten its monetary policies. It will have a negative impact on gold prices. Let's look at the next slide. If we look at the investors' behavior, first of all, I would like to note on the right-hand side on that graph, with retail investors, those who invest into ETF, exchange-traded funds. So they've been going down since 2009 after that peak. In 2021, their total amount lost 10 million ounces of their reserves. And so that tells us that retail investors are not very positive about future prospects. If we look at institutional investors, on the left-hand graph, it's not as obvious, but we see a greater number of short-term positions and contracts and a reduced number of long-term contracts. So that's about a bearish mood of institutional investors, which is prevailing. Our expectations going forward, so if we go back to FRS, It's a tightening of monetary policies. The current growth of inflation will make the regulator to respond to tighten its rhetorics. Most likely, we'll hear that in December at their meeting next month, where it will start a tapering program of buying assets, even at faster rates. It will be a signal that rates will be eventually raised. You can see here how yield on treasuries, which is the main competitor to gold, it depends on how much regulator buys assets. The more the regulator buys assets, the more yield you get. Also, tightening monetary policy impacts not only treasuries but also the US dollar. So the higher the rate, the higher the yield in dollars, the more people will be investing in the dollar. It'll be more attractive for them because it's also a reliable asset. And gold, once again, for those people, for those who work in other currencies, gold will lose attractiveness for us. So we have two fundamental factors that will put pressure on gold prices going forward. Consequently, our forecasts for the gold are not very promising and not very positive. So in mid-term and long-term, because monetary policies will be tightened, because the regulator in the United States will be increasing its rates and tapering its programs at a faster rate, and its rhetorics will be more strong, it will have negative impact on gold prices denominated either in rubles or in dollars. It should be also noted that our analysts appreciate ruble next year. It's supposed to strengthen, and in 2022, as a result, so ruble prices may go down faster than dollar prices. And as I promised, some positive factors, which are unlikely, but they may still provide some support. I should note new stems of coronavirus. If they will be so resistant and that vaccines will not help those that we have currently, so it will lead to new lockdowns, to economic impacts. It will postpone those decisions on the part of the regulator. Another risk factor is weak recovery rates for the labor market in the US. That's an important indicator monitored by the FRS, and if recovery rates are weak, then the regulator will have to postpone its decisions on raising rates. And the least likely scenario, it's uncontrolled inflation, high inflation, nefarious inflation. So there is a chance it might scenario of the 70s will become true. So in that case, gold will be very successful, but it's unlikely. To summarize what I said, I would like to note that current levels are record high, are very good, and gold will have a correction from here because of the tightening of monetary policy and stronger rhetorics, and we'll see prices go down in the long term. Thank you, colleagues. It was a pleasure to share with you about it. I wonder if you have any questions. I will be happy to respond to them. Thank you so much, Anton. To continue, I would like ask our next speaker to speak. Good afternoon, colleagues. Welcome to our event. Because of the lockdown, I participate in a remote format, but on the other hand, it's great that the forum, besides the traditional offline format, has this online format, which helps to expand our audience of viewers and listeners. I would like to introduce Anna Morina, head of the Analytical Center of Открытие Research. We are a competency center on markets and economy. We also generate investment idea and recommendations. So when we analyze gold markets and its prices, just our colleagues, we take into account what the FRS does, also yield of US Treasuries, market situation. But in my speech today, I would like to look at the market from a different angle and to highlight some issues in the gold mining industry in the following decades and also production costs. And also, I will try to find the price, that minimal price that gold will hit before it rebounds. We can see here that in the previous decade, gold mining industry was a difficult period for it, and because there was a hike in prices in around 2011 and 2012, but other than that, gold prices were moderately low from 2019. It's middle of 2019 we saw growth. We see that prices added 40% compared to the first half of 2019. It's a dollar denominated prices at the peak. Growth reached 60%, which was almost unprecedented, an unprecedented spike. And mostly we saw it in the last coronavirus years, so to speak. And understandably, the companies that work in gold production benefited in that situation. In 2020, all of them, had great performance. They reported on it. In this year, we also expect their performance to be good for all the companies. And that performance is at very good level in terms of their share price, in terms of their profits, in terms of reducing their debt burden, and so across all the board, on all the parameters. But all the good things eventually come to an end, especially that was too good and for not so good reasons. And here's what happens when we have high prices. So, on a positive note, we see that costs for exploration for companies have been higher somewhat, and reserves across 14 largest gold mining companies compared to 2018, the year when the prices were moderately low. Reserves went up by 17%. If we look at the lower graph, we will see that exploration budgets also grew, but we saw that growth mostly in 2021, not in 2020. But some restrictions were in place. But when we compare that to peak budgets for exploration back in 2011 and 12, so what we can expect in 2021, it's still 36% lower. And we calculated that over the last decade, from 2016 to 2020, average expenses on exploration were $46 per ounce. We will use this figure going forward, so let's keep it in mind. Next slide, if we could. As stated before by Anton, and many analysts tend to think the same way, even those who were polled by Bloomberg, because of tightening of monetary policy in the United States and reduced liquidity and greater yield of treasuries, gold prices most likely will be corrected. And so, of course, there are different opinions what trajectory will be like and to what price those prices will go down. But the main idea is that everybody thinks that that scenario, that trend, is the most likely one for gold. So this is what companies, here's what companies will face in gold mining sector. So, on the one hand, lower prices will impact their EBITDA and profit and revenues. On the other hand, during lower prices, during those periods, companies cut their capex, and we'll see it on the following slides. But I would like to note why it can become a problem even now. So the current situation is quite interesting for two reasons. Over the last 30 years, from 1990 until 2010, during explorations, they discovered 6 billion ounces of gold, and out of them, 10 million ounces were discovered in the last decade. So much less. And on the graph, you can see reserves of gold, what was mined before from deposits that had been explored previously, and exploration costs are counted in the year when they started exploration. So once they identified the deposit and started to explore it, so the budget for exploration follows gold prices and its dynamics, but physical costs are during that year when exploration started. And we see that in 2016 and on, we see fairly small volumes coming up. We also see from 2018 to 2020, no major deposit was discovered, and reserves were down on companies' balances by 11%. And here's what happens with planned production. Without discussing 2022, where in 2023, we don't see any major problems for the industry, but if we look further, we can see that all existing deposits will be eventually depleted, and unless they're replaced or unless they're switched to reserves, then decline may be very significant when we talk about production. We hope that will not happen, because companies do have ways to avoid that scenario, and that delta of decline, and transition from resources to reserves can provide for 10% of production until 2026. And here's what companies need to do. Next slide. Once again, this is about exploration. And I stated before, capexes generally, and including exploration, they correlate very well with gold prices. So the yellow line is gold price, green one is EBITDA. You see that those two lines pretty much coincide. Capex has this particularity. It has a small lags after the price goes up, but when the price goes down, it collapses quickly. So from 2016 until 2020, when prices were relatively low at the beginning of the year, so we saw some investments in the industry, and everybody was forecasting growth and actually forecasted lower prices until 2024. So most likely we'll see the capexes will be also cut, reduced. On the one hand, companies have less reserves because they're depleted. So how can they be replaced? How those volumes can be replaced? It can be done by buying companies with proved reserves. And in fact, we do see a lot of activity in M&A market. And for companies, it's a good way to ensure their security in terms of resources. And we saw that average M&A transactions in 2016, from 2016 to 2020. So there was a 62 ounces, dollars per ounce of gold, and while and the in terms of its exploration, every ounce was $15 to $20 cheaper. So of course it's more profitable to invest into exploration, but exploration has some risks of uncertainty. But M&As, you buy something understandable, you understand a deposit that has been already explored. So why this way can be less interesting from the perspective of industry as a whole, if those deposits from one company to another, their total amount is not changing, it's just restructuring. So there's a greater risk for the industry that exploration will be underinvested. It will be under investments in exploration. So we put together the price that we have for mining in current deposits, and we calculated how production costs will behave if we will see lower productions rate in current deposits. So budgets for explorations, M&As, and gold price should be above $1,450 per troy ounce for the industry to be able to exist for a long time and to continue to mine gold, produce gold, and at the same time to be able to pay their shareholders and have good profitability, and generally so that companies would continue their investment activities. I would like to summarize. So the upcoming decade will be very interesting for this industry, because on the one hand it had a good start with high performance, but eventually it has a risk of becoming a very complicated industry in terms of mining and having resources. Thank you for your attention. Thank you, Anna. Thank you all the presenters for your great presentations. So let's summarize this analytical session. We learned that gold gives you good hedge in your investment portfolio from market downfalls, especially when uncertainty is high. As John said, optimal volumes of gold in your portfolio is about 5%. Speaking of prospects of gold prices, so market consensus currently is that peak prices were last year, and the following quarters we can see some sideways dynamics. So in the area, in the ballpark of $1,500 to $1,700 per ounce. Now I would like to hear you. What do you think about key trends, and what are the key challenges for the industry? So from what I see, participants did not receive any questions. I would like to thank you all the participants. I give the floor to Vasily Zablotsky.
Dear colleagues, we had such an exciting discussion that the time just flies, and so this that brings our forum to the end. And I would like to thank our panelists, for their presentations and for taking questions from the audience, and then this will be also collected and posted on the website of our association, and so you'll be provided the access to the materials, and as part of our platform and within framework of the broadcasting event. And I would like to thank our VTB, Power Moscow, exchange cross with MED and our silver sponsors at Pромsvest Sovcomsvest, FK Открытие, and Uralsib Bank, and then the Russian Agricultural Bank or the Rossельхozbank that is supporting our event. And see you.